Hey everybody, Mark Yegge. Welcome to another weekly update. Today is March 24th, 2023. Crazy stuff going on out there. We are in a red market. Let me show you what I got here. All right, here's my market timing system. This is showing 4 red lights. Stay away from this market. There's too much risk. It's the bank failures that are happening. It's inflation that's going up. It's the Fed printing money. It's all of that. We'll talk about that a little bit as we go through this, but this is not a market. This is not a time to be a hero and try to pick the bottom. I don't know if there is a bottom here or not. I just know the probabilities are not stacking up right now. It's a red market. All right, here, I'll show you why. Here's the NASDAQ, right? The NASDAQ right now is showing that it's up above the 21, the 10, the 50, and the 200. Really good stuff. But this is the best performing index out there. Apple's going up, Netflix is going up, Nvidia is going up. So the technologies are performing because a lot of money is coming out of the banks and into some of these assets, even though they're tech, they're considered safer. And so people are saying, well, if the Fed is going to print money by saving the banks, then there's free money out there, and these technology stocks are going to go higher like they did in 2020 and like they have always done every time the Fed prints money. So the NASDAQ's doing okay. Look at the S&P 500 though. It's testing the 200-day moving average. It's not looking strong at all. It's kind of in the middle of a downtrend, trying to buck it, but not doing a very good job. S&P 500 is in trouble. The Dow Jones Industrial Average also in trouble. Look at this thing. It was doing great a few weeks ago, and now it's getting hammered. It's living below the 200. We don't want anything to live below the 200. That just means bad stuff is possibly going to happen. And this is all probabilities anyway. I don't know if it's going up or down. I don't know anything. I could just tell you from reading the charts that the probabilities are not good. They're not in your favor if you're a bull. So look at this one. 2.5 weeks of red. Look at all the red bars under the 50-day, under the 200-day moving average, that black line there. That is not good either. That's the New York Stock Exchange, and that has a lot of the banks in it. That's why it's down. The volatility has kind of reverted to the mean. It went from 18 to 30. That was a huge move a couple of weeks ago, and now it's reverted back to the mean of around 23. So it doesn't really tell us much either way, but it could go up or could go down. Right now we're at that spot where we don't really know, but it's always nice to know that the VIX is in play. Look at the transportations though. The Dow theory says when the Dow Jones transportation average is down or it's trending down, the Dow Jones Industrial Average will follow. The Dow Index will follow. And it sure is. Look at this crazy, lousy chart. Like, I only see 2 blue bars out of the last maybe 10 or 12. This market has been selling off. And if people aren't moving goods around with transportation, that means they're not selling goods, or they're predicting that goods are not going to sell. And so there's a sell-off going on in transportation that's bleeding over into the industrials. That's not good. It's recessionary, and that's lousy. I found this to be interesting. This is the community bank index, and you can see everything was humming along just fine around the $55 level, and all of a sudden when we started having bank failures, we just got a big crash in the regionals and in the community bank index. So there's trouble in the banking sector, guys. You have to be aware of this. If you're not aware of it, I can't really help you when on the other side of this. And let me tell you what's going to happen. So the Fed is going, okay, these banks are failing. So what they're doing is they're giving them money to bail them out. So they made stupid investments. They put money in treasuries, which are supposedly safe, but the Fed raised rates and those treasuries went down. Remember, there's an inverse relationship. When rates go up, the value of treasuries and long dated safe money goes down. And so you're a company in banking at Silicon Bank, and you've got to make your payroll. So you got to spend $500,000 to pay all your people. Well, you go to the bank and go, I need $500,000. And they go, well, we don't really have the $500,000, right? You try to write your checks and they slow you down. What do? You tweet it out to all your friends. And you're like, Silicon Valley Bank won't give me my money. And then everybody goes and writes checks or tries to wire their money out. There's a run on the bank. And that's why we have problems in the banking system. So they've got the assets, but the assets are severely marked down. And the Fed basically said, that's okay. We'll mark them back up. We'll give you the amount of money that you paid for them, even though they've declined in value. Well, that just basically takes all the risk out of business. And when you take all the risk out of business, it's not business anymore. It's just giving money, free money to your people. And when you give free money to your buddies, there's all kinds of repercussion, and you're seeing it in the grocery stores, right? You're seeing eggs go up and all this inflationary stuff. Cars have gone up, and it's not stopping, right? It's not stopping. I don't care if the Fed says we're only going to raise a quarter of a point, get to 5.5%. Mortgages are around 7% almost now, and that's slowing down that part of the economy. But on the other hand, they're printing free money. So there's going to be inflation, massive inflation that's going to continue. It's not going to stop. And at the same time, what they're doing is they're constricting the value of banking. And what they're going to do is they're going to try to roll out what's called a CBDC, a central bank digital currency. Sounds fine. Sounds like a crypto. Sounds, oh, it sounds good. It's really, really bad. Really bad. It basically means that one person or one group of people controls your money from a centralized location. And so what's going on in China is if you don't, have a good social credit score. In other words, you're not putting out enough tweets or enough posts that the government is great and President Xi is awesome and all these really great things that fall in line with what the government wants you to say. They put limits on how much money you can spend. If you spend too much money on a gas-powered car, they're going to tell you can't spend any more money to go on that trip you wanted to go to. Do you want somebody controlling your money like that? That's what a CBDC is going to do, and it's coming fast. You've got to be prepared, and you've got to figure out a way out of the system. And let me tell you what they're doing in Florida. DeSantis just put out an edict that says we don't want CBDCs in Florida. So if you got a government around the United States, your state government can say, oh, we don't want CBDCs either. Maybe Texas is next, maybe Arizona's after that, maybe Wisconsin. But if enough states band together and say, we don't want this centralized currency constricting our people, then I think we might be able to head it off. But you got to get involved. You got to call your senators. You got to call your congressmen. You can't let them have one person that controls it. Look at what Jay Powell does, controlling the money of these banks. I just showed you the chart. That's going to be the chart of your life if you let CBDCs enter into your life. All right. I don't want to end on that. I want to say there's always opportunity out there. It's just right now is not the best time. There's a lot of risk in the market. Will the market change on Monday? Who knows? I don't know. I don't know anything more than you do. I could just tell you that I read charts and I've been doing it for a long time, and I play the probabilities market. And the probabilities right now are not to be touching the market because there's just a little bit too much risk. So be careful out there. Thanks for tuning into the weekly market update. Hope to see you next time. Take care.